Opening a banking app and tapping a button next to a suspicious charge allows a consumer to receive an immediate credit. For the buyer, the friction ends here. The balance is restored, the notification disappears, and the transaction feels like it has been resolved. But there is a technical distinction between a refund and a chargeback. A refund is a voluntary return of funds from a merchant. A chargeback is a forced bank payment reversal. This provisional credit initiates a highly regulated conflict between financial institutions that can last for months. This network of intermediary banks bridges the gap between buyers and sellers. In digital commerce, where the parties never meet, this system is the primary mechanism used to enforce accountability. The dispute brings two proxies into the field: the cardholder's bank, known as the issuer, and the merchant's bank, called the acquirer. The issuer initiates the process by withdrawing the disputed funds from the acquirer. This happens automatically, without the merchant's prior consent. The merchant immediately loses the revenue from the sale and is charged non-refundable administrative fees ranging from $20 to over $50. Every dispute is categorized by a reason code. This is a specific designation from the issuer that defines the legal basis for the claim, such as fraud or merchandise not received. To recover these funds, the merchant must engage in representment, literally representing the transaction to the bank with proof that it was valid. Merchants operate under strict timelines, often having only 10 to 45 days to compile their entire defense. Missing this window results in an automatic loss. The required evidence is specific to the reason code. Countering non-delivery needs signed tracking data, while fighting fraud requires matching IP and CVV verification. Once packaged, the acquirer transmits this data back to the issuer for a final ruling. Representment changes the nature of the transaction. The merchant is now essentially a defendant in a closed-door trial, where they must provide a documented evidentiary trail to prove the cardholder's claim is false. If the issuer accepts the merchant's evidence, the chargeback is reversed, and the original funds are returned to the merchant's account. However, the issuer may reject the evidence or provide new information from the cardholder. This leads to a second chargeback cycle, often called pre-arbitration. At this point, the merchant must decide whether to accept the loss or escalate the case to the final stage of the process. Escalation moves the case to the global card networks. Authorities like Visa and MasterCard act as neutral arbitrators to settle the deadlock. Arbitration is restricted to the facts already submitted. The network reviews the transaction history and reason codes to ensure both banks followed established rules. The losing party is penalized with punitive fees that frequently exceed $500, a cost that can be many times higher than the value of the original purchase. The decision issued by the card network is final. There are no further channels for appeal within the banking system. These high fees act as a deterrent. They are designed to force merchants and banks to resolve disputes independently, rather than clogging the network with minor claims. A single tap on a phone can trigger a 90-day global conflict involving 4 different institutions and thousands of dollars in potential penalties. This raises the question of why the system is designed to be so adversarial and strictly regulated. Historically, these aggressive consumer protections were necessary to build public trust in plastic money. Without a guarantee that their funds were protected from fraud or bad actors, consumers were hesitant to adopt credit cards. In the modern economy, this process provides the formal structure needed to resolve conflicts when merchants and buyers are separated by thousands of miles. It offers a standardized way to filter out illegitimate claims while forcing businesses to adhere to their service agreements. The chargeback lifecycle is the structural foundation of digital trade. It creates a framework of accountability that allows strangers to transact with confidence in a faceless global market.